We start today's market talk. What we have seen is a counterbalance to uncertainty. Given the current heightened uncertainties in trade and geopolitics, the big rate cut is meant to counter that by boosting the domestic economy. So why I have written it's a bounty for Mr. Market, because I think now if you have read the signals correctly, the markets there is no reason to be short. It will be a long trade now all over. So firstly, RBI's big monetary stimulus, which took almost everybody by surprise, was actually a huge thing, because you got a rate cut which was higher than expectation and a 100-point CRR cut. That means lot of liquidity in the system. Now we all know that the demand for liquidity in the system is not that great. So if the demand for liquidity is not great, you very well understand that where does this liquidity go into? It will inflate the asset prices of equities, real estate, everything else. So what RBI was not going to cut the interest rate this big, but the extent of cut was surprising. Along with 50 basis point cut, they reduced the cash reserve ratio to 3% from 4% in 4 tranches beginning September this year. It is expected to release 2.5 lakh crore into the system. Now, 100 basis point cut in cash reserve ratio would ensure swift transmission of rate cuts by the banking sector, boosting the growth rapidly. Now, all these cuts, etc., are landing up during the peak monsoon season, helping the farmers, and ahead of the festival season that will benefit rural and urban consumers. So it's an economic stimulus ahead of the peak purchase season or the peak festival season for India. It frees up funds for banks, which, if deployed in higher yielding avenues, improves the outlook for their earnings. That's why the Bank Nifty went up. Now, this will help the broad-based and durable consumption recovery, which is increasingly critical for the revival in the private capex cycle. Now, the basic thing which we saw last week on the GDP numbers was that the private capex growth was around 6%, all three. So this will help that, because there is presently what is observed is a risk aversion in the increasing cash and bank balances of India Inc. Higher private capex and muted urban consumption is reflected in banking system's credit growth that has fallen to below 10%. So and RBI is seeing all these things. There are muted sale of vehicles, there are muted credit growth, etc. Hence, it is not just just out of the blue. There is a big thought behind it. Inflation is at right now pretty low, around 3.5%. So a bumper rate cut and liquidity boost will increase credit offtake by the banks, and the basic whole economy moves on credit only if the credit cost reduces. Now, discretionary consumption ranging from real estate, autos to tourism stands to gain. Injection of liquidity is expected to lower EMIs, borrowing costs, creating more discretionary cash for the middle class and MSMEs, thereby providing surplus cash for discretionary spending. So things like apparels, footwear, QSR, jewelers, tourism, luggage, etc., everything will benefit. But the primary benefit, in my opinion, will be in the real estate value chain. Real estate developers, building material companies, and electronic majors who supply over the ancillaries for real estates will gain from these improvement in the trends which are there right now. Entire downstream of auto ancillary chain should benefit from a positive rub-off from auto OEMs doing well now. Because the next thing people buy is a vehicle, because the EMIs become lower. So two-wheelers, passenger vehicles will see improved demand. CV players, that is commercial vehicles, along with entire auto ancillary chain should also benefit, because it's a whole system which gets into motion if there is more demand. Now, capex heavy sectors like real estate, chemicals, defense, infrastructure should reap the benefit from reduced cost of borrowing and easy availability of credit for project finances, because a decline in interest rate will improve the project IRRs, leading to strong cash flows and healthier balance sheets. So that is one. Next is businesses heavily reliant on working capital finances will get relief. Now, all these businesses, like which are doing government projects, water treatment, engineering firms, etc., transmission and distribution players with long payment cycles will get relief. It will enhance ROEs for them by 100 to 200 basis points, which will directly flow into profits. Bank margins to feel near-term pressure, partially offset by treasury gains and lower credit costs. Now, what will happen with banks is that's why the Bank Nifty dipped initially when what the RBI governor said that he is announcing a 50 basis point rate cut and change of stance to neutral. So change of stance to neutral was he said that we are done with rate cuts, no more rate cuts are needed, and so we are changing our stance to neutral. Now the Bank Nifty declined, but because the banks will now see a sharp decline in NIMs as impact of RBI's cumulative repo rate cut by 100 basis point will result in yields on advances getting reduced while deposits will get repriced with a lag effect. GSEC yields will also, but GSEC yields will moderate, resulting in treasury gains for them. So other income will improve. Hence, the key determinant of bank profits now will be treasury gains and operating efficiency. So one has to be very careful in deploying in banks. In my opinion, large private banks which have laid down procedures, big treasury books, etc., will benefit, and also banks where valuations are attractive. NBFCs will be a clear winner because there will be lower borrowing cost and higher amount of borrowing. So they will benefit as the cost of funds will decline. Home financiers, auto financiers, consumer financiers should all do well. Now coming to FI data. So FIs on Friday added net long positions around 14,000 odd positions. So they reduced their net short positions. They were majorly bullish on Nifty Bank and Midcap Nifty. As I had mentioned, because the lower borrowing cost actually helped the mid caps and small caps more. Professionals have turned negative, so that is so they added some short positions. And what I was pointing out was these 92,000 odd short positions are the which index futures FI positions is the one which will turn, which they will do short covering. So market moves up because of short covering. This will drive the markets higher, and even pros have short positions. The clients also added short positions as counterparties to FIs. The other issue is that DIIs are, as part of hedging, I think, are net short on stock futures of roughly 40 lakh positions. So this is again, this will push the indices higher. So if you see the monthly data, so from lower levels of around 13,000 short positions, it had gone up to around 1.07 lakh short positions. But then it has declined after this rate cut on 6 June. And Nifty is at the same level, that 25,000 level and all. And now subsequently it is expected to move. Now coming to the US, the sentiment was boosted by positive developments on trade front and encouraging labor market data. Trump and Xi had a phone call on Thursday. And then on Friday, Trump informed that members of his administration would meet Chinese officials for trade talks in London on 9 June. Hence, that has boosted the sentiment and the markets rallied. The job openings in April came in higher than expected, and on Friday, non-farm payrolls came in stronger than anticipated. So now what happens is the economy, it is proving that economy is not weak, economy is strong. So there is no joblessness. Hence, the probability of rate cut reduces. So the bond yields went up. I'll show it to you. And S&P 500 reclaimed the 600,000 level. So if you see here, last week, the US bond yields went up. They were up 2.5% because expectations of rate cuts have reduced. The dollar index has declined, which is good for metals, etc. But it is stuck at 98 to 100 odd level. So let's see what direction it goes. Crude went up because around 4.25% because of 2-3 reasons. Expectations of conflict in between Ukraine, etc., and Russia. Plus, if there is better trade between China and the US, there will be growth in the world. Hence, the requirement of crude, etc., will be more. So, crude went up. I think it is. Let's see if we're able to get through this 20 EMA on the weekly chart. Gold declined. So as the uncertainty had reduced, etc. So it has come back to the trend line. So we'll have to see if it can break this trend line. Now the surprise factor was silver, right? It went up. It broke through, was up 9% because of basically shifting it's basically an industrial metal, and the money was moving into now gold and silver, but silver has continued to move up. And all over in India also the silver prices have gone up more than a lakh rupees now. Copper also went up. So if you see it's up around 4%, right? So it touched that that upper trend line resistance or whatever it has gone up because dollar is declining. Hence, so all the metal prices are supported. Plus, there is a hope that there would be better growth in the world or better demand for all these industrial metals because of better relationship between China and US. Okay, silver we have covered. Bitcoin declined. Again, lack of uncertainty now. So the money is now moving into metals. From gold, it went into Bitcoin. So the Bitcoin had rallied. And now Bitcoin is declining. People are booking profits and money is moving into now metals, etc. S&P 500, I told you, reached 6,000 odd level. So that is positive. So once now is that all-time high again is possible for it. Nasdaq again moved up around 1.97%. There was a to and fro movement on Tesla, but Nvidia is the one which is powering the Nasdaq. And Dow also was up 1.7%, now clearly trading above the 20 EMA. Now India VIX, it had gone up, now declined on all days. So for Friday, it declined around 3%. So it has come to that 14.63 level. So from here, if it declines more, then the volatility will reduce. So it should come down to below 14 level. So generally, like these are the levels it trades between 13 and 14, where it is stable and all that. So these spikes will reduce. So let's see. Now, coming to Nifty, this is the weekly chart. So if you see the retracement, it has taken support at around 61% retracement. And the next logical target should be this 78.6, that is 25,300 from here. Strong green candle last week, up around 1%. And then once it takes out 25,300 over next week, I think, and then it will try to go for the all-time high. So it's a big boost. So people will pre-position now, and you will see a lot of short covering happening. On the daily chart, if you see here, it has taken support around 20 EMA. Whenever it dipped below it also, it went up, and then it bounced from 20 EMA on Friday. So this immediate 25,116 should be the first resistance. Once it starts trading above that very clearly, then it should head to the 25,300 level and then back to the all-time high. So, and RSI is supporting. On the hourly charts, if you see this this week, generally it was moving around in this range. Lower level 24,500, upper level it was touching around 25,000, and then getting back. So on Friday there was a clear breakout, and then now it is at 25,000 level. So every dip it becomes a buying opportunity, and it is bullish till the time it is above the 20 EMA on the hourly chart. Now coming to Nifty Bank, this I had last time also told that this is last week I clearly told that this is waiting for a breakout. The breakout took place on Friday. So for the week it was up 1.49%. So it has broken above that previous high, where it was consolidating for quite few weeks now. So once it clearly trades above this, I think it should go to around 58,000, which is very simple now. You can see from the option data. Uh, Nifty Bank, as I had shown last time, is making a flat pattern. So once it breaks out from here, the possible movement is generally the length of the pole. So this here is around 6,000 or points. So from breakout point or from 56,000, the likely target over some time is 62,000. But let's see how far it can go immediately. But suffice to say, it can easily go to 58,000 or. So I'll show you, as I was mentioning about trading. Now this is a Nifty Bank 5-minute chart. So if you see here, on Friday, it was muted till the RBI policy. And this is where I told that I have taken a long position on Nifty Bank, right? Somewhere around here, I had taken a long position. Then the RBI policy was announced. There was a big green candle. It went up. It became profitable. And then it turned back moment he said that he's changing his stance. So I had closed my position here because moment he said that he's changing his stance to neutral. So the market corrected. So then we saw for 10 minutes two big red candles, and it came back to the same level of 55,500 odd. And then the RBI governor announced that there is a CRR cut of 100 basis point, and then the market shot up. So again, once it crossed this 20 EMA on 5 minutes chart, this blue line, I again took a long position. Now this was at 55,700, right? So I carried it up to this point. After that, it started going. So I carried it up to around 56,500. So somewhere got around 800 points and then booked profits here. After that, I'll show you with respect to VIX also, because VIX started going up. So I had closed my position, and after that it just was going sideways. I again tried to take a position as the VIX started falling around 12:30, but didn't make really any good money here. And then at the end of the day, closed it. So this is how I traded on Friday. Now I'll show you with respect to VIX. So if you see, as I told you, the VIX was declining, and then there was a big decline after the RBI policy. So the premiums fell drastically. So that was good. And this is where I was telling that the VIX started rising. And once the VIX started rising here, this is where I had closed my position. Switch off your volume. Okay, so I had closed my position here. And then when the VIX started coming down, I had again taken a position and then closed it somewhere here. So that is what it is. But you have to watch the VIX, because the market starts dipping as the VIX starts rising. Now coming to the option data, what I was telling was that if at 55,700, this is the 26 June option chain, at 55,700, so if you had bought a call that is at the money, on that day you would have made around 475 points. So that is 475 into 30 is the lot size. So roughly around 15,000 rupees you would have made. And if you had sold a put, you would have made lesser money at the money. That is around 274 per lot, right? So that would have been lesser, around 8,500 rupees. So you would have made. Now the point to note here is that the maximum OI, if you see, is at 56,000 in terms of calls and puts. So a lot of people are stuck here. So this is what I wanted to highlight. Now, these are the guys, if they want an exit, they would like to bring the market closer to at lower levels so as to take an exit, and then the markets will come down once they start they're closing their positions or squaring their positions. But these guys are vulnerable. So, and if you see, the position build up is maximum at 56,000. And if you see the open interest at this point is around 1255. And 486. So roughly around it's around 1800 points. So that means what it is showing is that for this month, what they are expecting is a range of roughly 2000 points, that is 54,000 to 58,000 over this month for Bank Nifty. So that's what I was telling, that possible target for Bank Nifty should be, as per the option data, around 58,000. Now why it moved up? It was led by HDFC Bank, and in my opinion, this HDFC Bank, once it crosses 2000, now it is challenging that this will lead the Nifty higher and not anything else, because there is a HDB Financial IPO also, which will get a huge subscription. The other important part is Reliance. Reliance was up 1.59% last week. It has yet to break out above this 1450, 60 or level. So it is consolidating. So let's see which direction it goes. I had last time pointed out that this is a declining trend line. So once this is taken out, the Midcap index will go up. And this is what happened. So it bounced from there, it broke out above that. And now it is in that blue sky. So first target should be around this 13,400 level. And after that, it should go up, because mid-caps are the most likely to benefit from, mid-caps and small caps will benefit the most from rate cuts. So similarly with small cap index, it was up 3.91%. So if you are there, stay with your small caps, good small caps, they should perform well. I think it should go back to its previous high, around 19,600 very quickly. That's it, around 1,000 point move from here, which can happen in a very short time. So the summing up is that we are not going to fizzle out after the RBI event. And so don't start becoming jittery, insecure, etc. These things will keep going well only because unless there is an adverse news which emerges, otherwise things are good. The rate cut and the RBI announcements are generous. So now everybody will take the cue from this and will deploy money. And I think the first clear signal of this up move would be moment the FIs start covering their short positions in index futures. So once that starts happening, that will be a signal that breakout will last. And that is that you will see on Monday only. And that will tell you as to whether swing trading is enabled. And you have to get out of that day trading mindset and look for larger moves and bigger profits. So now I'll cover two stocks. So first is Shriram Finance. Now this is basically related to NBFC. So what will happen with the Shriram Finance now is that margins are expected to improve going forward, supported by gradual normalization of excess liquidity and repo rate cut. They are changing their product mix with a higher contribution from non-auto segment. It is expected to support blended yield expansion, further aiding margin improvement. Otherwise, what they were concentrated was on CV's financing. So they would move with the CV cycle. So now they are diversifying into other products. Favorable monsoons can lead to higher agricultural output and a stronger rural cash flow, which in turn will drive credit demand across the vehicle finance and MSME segments. It can deliver a PAT CAGR of 19% over FY 25-27 and ROE of 3.3 to 17% in FY 27 expected. Diversified composition of company's loan book has mitigated its exposure to cyclicality of CV business and help in improvement in yields. About 30% of company's borrowing will mature in FY 26 and will be repriced at lower rates. So that should help them. The problem with Shriram was that their asset quality deteriorated in FY 25 and margins compressed due to surplus liquidity from ECBs they had issued. ECB is external commercial borrowing. Now they had a lot of cash, but they had no requirement because the economy had slowed down during the year due to elections and lesser government spending, etc. So the requirement of commercial vehicle financing reduced. But if they now they have changed the trend as they are diversifying. So what can happen is that price to book ratio at which they trade can improve if it can sustain its AUM growth and improve its margin and exhibit stability and asset quality. So let's see there. What they are talking about is a AUM growth of around 17% CAGR over the next 2 years, which should be decent, and spreads to improve, and they would be supported with lower cost of borrowing. So if you see, their spreads had dipped over last 1 or 2 years, but they are expected to improve. NIMs are also expected to improve, and cost to income ratio is also expected to remain subdued. So the cost to income ratio is coming down, which is good right now. So operating expenses are also coming down. Now their AUM mix remains primarily CV financing, that is 45, but they are diversifying into personal vehicles, construction equipment, which is a big one, farm equipment, MSME. Now everybody is trying to get into MSME financing, two-wheeler, gold, and personal loan. So gold and personal loan, everybody is finding it to be very attractive, including MSME financing. So what is improving, if you see over a period of time, is their personal vehicle financing, which is showing a good growth, and MSME financing, which is again showing good growth, while their reliance on CV financing is reducing. Now, if you see here, the GNPA in MSME and personal loans improved over the last 5 quarters. So they have shown a clear improvement in that. And auto products gradually improved over the last quarter. So they had deteriorated in terms of GNPA in Q3, etc. If you see, overall it had gone down, but it has shown improvement in Q4. So if this trend improves, then they should do well. What they are talking about is improvement in net interest income of roughly around 18-19% over the next 2 years. And operating profit should go up around 20%. So this is what is expected. They are expecting. So with this, the NIMs should improve. NIMs on loans to improve to 9.8. The cost to income is expected to come down. ROA is expected to improve, so that should help the profits. GNPA, etc., should come down. PCR is improving, so they are better protected. So the book value is expected to be around 344, from around 300 now to 344 in FY26 and 394 in FY27, taking around 390, 400. Roughly, it can trade at 2 times book. So if you trade it at 2 times book, it can easily trade at 750 to 800 at 2 times book. Because if you see, others are pretty expensive. So the price to book is not very expensive, considering the decent asset quality and growth. So now, if you see this stock, it had corrected over last 2-3 quarters, and now after this rate cut, it has a clear breakout, around 5% odd. It went up on Friday with large volumes, and so this was an opportunity to buy this stock at every dip for a possible target of 800. But this is a kind of a portfolio stock, so you can hold it. It's in FNO also. You can hold it. First target should be around this 700, 720 level, and after that we'll have to see. But it's a decent stock, and it should do well in this excess liquidity environment. Now the next stock, which I found very interesting and I wanted to do it, was because I was so intrigued by the movement in Swiggy and Eternal over the last week plus. So I just wanted to understand what is driving these moves. So firstly, what are the key concerns? The number one investor concern is risk of competition in quick commerce segment, because now it is becoming diversified with number of new players coming in. And number two concern is potential growth slowdown in the food delivery segment. These are the two major issues which are impacting this segment, Swiggy and Eternal. Now, current market share trends to sustain, and food delivery business is expected to grow at around 15-16% over next 2-3 years. So that is given. That much would be there, not more than that, but that much is there as they improve their performance, etc. Now, expected food delivery adjusted EBITDA to improve to 4.1%. This is for Swiggy in FY27. So they will improve their net margins, adjusted EBITDA to 4.8% in FY28 versus 2.2% in FY25. So it should help. Adjusted EBITDA would nearly double over the next 2-3 years. In quick commerce, overall, total addressable market could surprise positively, and with aggressive investment in infrastructure, Swiggy should be able to regain same market share and grow gross order value at a 63% CAGR. So this is the driver for more money moving into these stocks. One, there is an upgrade of total addressable market. Now, as per I've gone through that broker's report, they are saying that India's quick commerce total addressable market will increase to 57 billion, US 57 billion by 2030. So that means it's roughly 50,000 crore market versus previous estimate of around 42 billion, and expect Swiggy to maintain its market share of 22%. So if the market is going to grow and you maintain your switch off your volume, please, and you maintain your market share, so that is actually good. Preference for Eternal over Swiggy is there, definitely. Stems from Eternal's market leadership in both quick commerce and food delivery, superior cost structure driving healthy unit economics versus peers, strong balance sheet, then competition limiting risk to any further equity dilution, and stock likely to see a potential floor at rupees 200 to 220. So if stock comes to 200 and 220, it gets bought. I've seen it now over a period of last 6 months or so, number of times. So that is a floor. Above that, it can keep going. And for Swiggy, out-of-home segment turned adjusted EBITDA break-even for Swiggy in fourth quarter FY25 and ceased to be a drag on the overall financials of the company. So these are the key drivers which is helping. One, food delivery will keep growing at 15-16%, and quick commerce total addressable market will surprise and market share will be retained. These are the two drivers for this stock right now, despite everything which is negative. Now, if you see for Swiggy versus Eternal, adjusted EBITDA as percentage of gross order value in food delivery to improve more sharply for Swiggy versus Eternal. So what is happening is it was really bad. So what is expected over the next 2-3 years, it will reduce the gap. So what will happen is because of higher operating leverage driven on fixed costs versus Eternal will retain leadership. So quick commerce adjusted EBITDA as percentage of GOV for Blinkit will become positive hopefully by FY27, and it will be less loss making for Swiggy over the next 2-3 years. Profitability gap on consolidated basis to keep narrowing for Swiggy versus Eternal, considering consolidated adjusted EBITDA as percentage of GOV. So basically, the profitability gap is expected to reduce, but Eternal will remain profitable. That's a key driver because that it increases their net profits as the GOV keeps increasing, gross order value keeps increasing. Now, what happens is Swiggy versus Eternal, the key issue is that you keep driving the Eternal valuations. So say Eternal is trading at a market cap, say 2.5 lakh crore right now. Now, what should be considering the number 2 players, market size, their market share, and their whatever revenue EBITDA they are making, what should be the discount? So what is happening is the discount which Swiggy was trading to Eternal it had reduced earlier, and then it went up to around 50%, and now it is say around 48 odd percent. But I think so. This is the key driver. So that how much should be the discount? So assuming the discount is 50% also for Swiggy versus Eternal. For Swiggy, the discount is 50% versus the market cap of Eternal. So what happens is, say if the Eternal is trading at 2.5 lakh crore market cap and it moves up 3%, so to maintain that discount of say 50% also, the Swiggy has to be moved up around 6%. It may not move immediately, but it will move with lag because that is the valuation comfort they have considering the overall market. So this is what is driving these stocks. So the key metric comparison, if you see food delivery wise, the market share is 57% for Eternal and 43% for Swiggy. And adjusted EBITDA is 6% of the gross order value for expected in FY28 is 6% for Eternal and 4.8% for Swiggy. For quick commerce, relative market share, because there are other players also, so between them, the relative market share is 63% and 36%. So here, Swiggy has a lot of room to grow. And adjusted EBITDA in FY28, this is expected to become positive, so it will be 2.7%, but it will be still negative 3.9%. So overall, revenue CAGR expectation is 37.8% for Eternal, so which is good, and 34% for Swiggy. Now, how many companies in India can expect to grow at 30% CAGR over the next 2-3 years? So that is the one which is driving these prices. So the price target as given by one of the brokerage for Eternal is 320 and for Swiggy is 405. In my opinion, they are still, the way the stocks are moving and the way the expectations are, it's very difficult to justify any price as such, because you can take this argument, I can talk about in different ways also, because there is so much of unknowns or uncertainties with respect to this business. And there could be government regulation, there could be other players coming in, somebody can, but expectations are that those guys who are growing will keep growing. Now, if you see the quick commerce market size, in India in 2024 was 8 billion USD. It has 2026, it has become 28 billion USD, and it is expected to grow 88% CAGR over the next few years from 26 onwards. It went up 88% to reach 28 billion, and it is expected to grow at 20% to reach 57 billion USD in 2030, and they are given for others. So it is expected to keep growing. But the major move has taken place now, or will finish in FY26, and it has penetrated to all segments: grocery, apparel, health and pet care, electronics and appliances, home products, others. And in e-commerce also, it is penetrating more. So earlier, out of e-commerce, it was 10%. It has now grown to 26%, and it is expected to grow to 32% of the quick commerce share. So this is this kind of market size is the one which is driving the money into these sectors. So if people are expecting that this should be the market size, so a lot of money is driving the valuation because of high amount of growth which is possible. So in the last few months, Blinkit has added new cities into these. All cities have been added by, so they are moving into class 2, class 3 cities, and Instamart has added these cities over the last few months. So dark store wise, there is a big growth. So by third quarter, Swiggy had around 705 dark store. Out of this, 501 in metro and 204 were in non-metro. So they are growing now. So what is their basic premise? What they are saying is, and I think this census will help them, because they are working on population density required to profitably service households in the quick commerce format. So what they are saying is, they need 1,200 orders per operator per day for a store, for a dark store to be profitable. and if there are 3 operators, so you require 3,600 orders. So number of orders for a full month required for all 3 is 1,08,000. Monthly transaction users considering are 8.5 x in terms of frequency of orders by each monthly transaction user. So in that place, you require around 12,000 monthly transaction, 12,706 monthly transaction users. And so they order 8.5 times, and then you get 1,08,000 orders. So per household, considering you have around 1.6 monthly transaction users, so number of households needed for 12,700 orders are 7,941. So penetration of quick commerce in such a locality is say around 15%. So the locality size should be around number of households in that locality should be around 15,571. Number of people per household 4.7. So population in that locality should be around 73,800. So what generally happens is if you take area to pi r square, so of a circle. So if a dark store is in the center, it can service an area around 2 to 3 kilometers circle. So the area total comes to around 13 to 14 odd square kilometers, which they can circle. So density in that locality should be around 5,300 people. Considering total number of population in that locality is 73,000. So for 13 square kilometers, it should be 5,000 people. So what they will do is they will see where all these densities of population are there and install the stores accordingly. As per their estimate, you will get around 45 to 50, that is 4 to 5 crore households in this range. And this is the basis on which this calculation is based on. So if you see number of dark stores, fourth quarter Q4 FY25, Blinkit has reached 1,300. Their target is to reach 2,000 by end of for calendar year 25. December 25, they want to reach 2,000. So there is a lot of money there which is going to flow into this capex, and Swiggy is following them. Area under dark store management wise, if you see for fourth quarter, this is 4.2 million square feet and 4 million square feet. But where Blinkit gets a push is because the GOV per dark store per square feet is higher as compared to Swiggy. So they are more profitable per square feet. So their return on investment or return which they're getting from the same area is much higher as compared to Swiggy, and that's why they are improving or they're doing well. And this is what the Swiggy is expected to improve, to narrow the gap versus Blinkit. So that is the point. The whole point comes down to how much discount you should give to Swiggy vis-a-vis the valuation of Eternal. Now, considering their revenue, so if you see FY25, this is millions of rupees, so roughly 15,000 odd crore. It is expected to double in the next 2 years. Gross margins are expected to remain in the 60% range. EBITDA margins are going to be lower, but still the losses will decrease. And net profit percentage margins should also, the losses are expected to reduce, and maybe nobody knows. It's very difficult to predict for FY28. Things will keep changing as the competition evolves, etc. So it's very difficult to see, but suffice to say, they are not turning profitable in the next 1 or 2 years, simply. So you can say with that, though their revenues will improve, will grow up, will become double what it is now. So the revenue-wise, they will do well. Losses will reduce. That's a basic point. And they will improve their food delivery average monthly transaction customers. So that should go up in terms of 1.6 crore now. Average order values will keep going up. So that should help them because the margins are based on average order value. Food delivery gross order value should keep growing around 15-16% over the next 2-3 years. EBITDA margins will improve for food delivery. And for QC, monthly transaction users are expected to go up. The gross order value is also improving, and percentage improvement is phenomenal in gross order value in quick commerce, and that's why a lot of money is flowing into this part. And EBITDA margins are going to improve, so it will be less loss making over a period of time. Now coming to charts, so if you see the chart, it made a low of around 300, and that is the day we had bought it on large volumes, because that is the day uh, when the institutional selling was opened after the IPO. So the 300 became a base, and after that it has gone up. So once it goes above this 100 EMA at 377, it should head logically to around 400 odd, and that is generally the target given. So I think around 400 we will see a profit booking. It has gone up on large volumes in the last 2-3 days based on this brokerage report and lot of interest now, and it is now in momentum. Around RSI is around 72. So having seen this, what I understand is Eternal will keep doing well. So because they have got better parameters, so Eternal is making a nice now rounding bottom. It is also breaking out. So it has reached 261. So it has broken out with good volumes, and I think it should head back to this 300 odd level in case this momentum continues. So I have finished. We'll take questions now.